Shares of Restaurant Brands International moving to the downside this morning. That's despite beating on the top and bottom line in the fourth quarter. The company is seeing system-wide sales growth, signaling the continued strength of the consumer. Let's bring in Andrew Charles, TD Cowen Senior Research Analyst, to discuss more. Thank you for joining us this morning. So talk about the reaction that you're seeing in the stock price here and what this means about consumer resilience, this story that we keep continuing to hear in earnings.
Absolutely. So good morning. So on the positive, we were very pleased with Burger King US same-store sales of 6.4%, exceeded investor expectations for around a 6 or so, and the published sell side estimates around a 5. Then Tim Hortons Canada, really the big surprise this quarter, 8.7% same-store sales growth. Expectations were firmly for a 5. We're also very pleased with the disclosure around the home market franchisee profitability that surged for BKUS and fared very well for both Popeyes as well as for Tim Hortons. The stock reaction you're seeing today, I think, reflects a noisy EBITDA miss that we saw, largely due to a true up, for the Tim Hortons supply chain business, combined as well with some headwinds that the Burger King business faced in the Middle East, as well as Western Europe and China. I'd also point out as well that during the conference call, the company tempered the rate of development for 2024 for net restaurant growth of 4.5% roughly, from expectations of 5% before, largely due to China. So two kind of conflicting dynamics today. Very solid performance in the home markets, some more noise on EBITDA as well as on the outlook for unit growth.
How does that restaurant development also kind of flow through even into the franchisee story for this company?
Yeah, absolutely. I mean, think of the unit growth as more of an output for the efforts they're putting into place and the strength you're seeing for the U.S. And Tim Hortons Canada franchisee development. Particularly for Burger King U.S., it's fewer closures that are being guided to for 2024 versus 2023. And then the development story here, really an international story. Yes, you have some white space for the big brands in their home markets, particularly for Popeyes, but really about the unit growth expansion opportunity international, where it's very fertile for growth. China was cited, though, as the key reason for tempering the unit development pace for 24 versus 23.
And are you getting any indication of how the sands might change going forward? We've already seen sort of slower consumer consumption in China, a leading market that a lot of these companies still trying to expand in when it comes to fast food and fast casual.
Yeah, it's in terms of a blanket answer, we know the coffee business in China has been one where you're seeing irrational competitors that are lower priced relative to a Starbucks, for instance. And because coffee is such a high margin product, because the competitors are seeing economies of scale from rapid growth, as well as from franchising, which is also providing some cash flow as well for them. The coffee market's probably shown to be the most competitive, as it relates to kind of the hamburger and fried chicken market in China. Broadly speaking, that's been one where you're seeing more value competition heating up in those markets. Harder just given that the gross margin profile of hamburger and fried chicken not as good as coffee, so the discounts can't be as irrational. But China as a whole is clearly showing signs of slowing, and in the coffee business in particular, more competition that's really flowing into that.
When we think about these companies, what do they need to show the consumer in terms of menu innovation in order to retain the consumer spend, the appetite and mind share, as we're looking at a consumer that's looking for deals, looking for value, even in all of their purchases, especially within this food away from home category?
Yes, I've learned a long time ago that brands are known for what they're known for. So what I mean by that is if you see Popeyes doing an extension with chicken wings that were permanently reintroduced in November, that's been cited as doing very well for them. Burger King right now really leaning in hard to the Whopper. These are core equities of the business that I would expect to continue to really bear fruit as we're bullish on the outlook, for restaurant brands going forward. I would say what's really off-brand is when you see intensified discounts, when you see menu innovation that really isn't in a brand's lane. That's where I'd say it's a bit more worrisome. We're not seeing any signs of that here, though.
And I do want to ask, because last week we spoke with Jack Hartung, Chipotle's CFO, about what we're seeing in terms of wage pressure. Here's what he had to say about the minimum wage increase in California coming into play.
When that many people are going to get a significant raise, it's going to have a ripple effect. It is going to make things more expensive. I do think it's going to have an inflationary impact and make it a little tougher to go to the grocery store or stay at a hotel, and of course eat at a restaurant, whether it's an independent restaurant or a chain restaurant.
So, Andrew, do you think that, that when you look at the pricing for QSR, are they factoring in some of these added expenses? How much is that going to end up getting perhaps passed on to franchisees as well as consumers?
Yeah, so as it relates to the California FAST Act, or better known as AB 1228, on April 1st, you're going to see the minimum for a limited service restaurant with 60 plus locations across the country set at $20 an hour. And so what we expect is that at an industry level, it depends if a restaurant wants to offset the dollar impact of labor, in which case it's about a 5% price increase they're going to need to take. If they want to neutralize the percentage impact to margins, it's more like an 8% price increase that's needed here. So broadly speaking, our checks in the field suggest that's going to be the case by and large across the industry, a 5 to 8% price increase on average in the state of California. Jack's right. I mean, the ripple effect this sends for someone who's going to work in a different industry, and you name it, fitness, dry cleaning, retail, whatever it might be, that worker is certainly going to get a raise as well. So pricing throughout California probably will get impacted by this, but at the same time, a cosmetic or a market equilibrium wage increase is coming to give the consumer some more pricing power, to give the consumer some more purchasing power. So, a lot of speculation on what that's going to mean come April 1st. We're very curious, obviously, when it happens, what transpires thereafter.
Andrew, invite me to some of those checks in the field. I'll go in a QSR ride along. Look, just tell me when.
Come hungry, please.
Yes. Oh, will do. Andrew Charles, TD Cowen, Senior Research Analyst. Thanks so much for taking the time today.
My pleasure. Thank you.